Hello, everybody. Brian Stevens here with the National Real Estate Post and Mortgage Shots. I'm a loan officer at the Loan Factory on the CB Loans team in there. We do things different. We crowdsource. We get together. We identify problems and we figure out ways to overcome them. And right now, business is good, if you know what I mean. If you want to learn more about being part of our team and talking with me and my team on a weekly basis and really kind of putting together an infrastructure that will help you with your business for the rest of your career, go ahead and give me a buzz. Right here is my number. All right. So, hey, listen, today we're going to talk about some really important things. So I found the AHA graph that really explains everything with where we're at right now. And I mean everything. It's all encompassing. We have 4 topics that I want to get to today. We're going to bust through them, so just don't worry. This is not going to be a half-hour diatribe. We're going to get through this quickly. Right here, FHA loan locks to immigrants without permanent residency, including H-1B visas. These are people who do not have H-1B visas, people who are not permanent resident aliens, who are getting FHA mortgages. You can do these with I-10 cards. I'm sure every lender in the country knows this. And, no matter how you feel about this, here's how I see it. I don't want to talk about an immigration policy that has nothing to do with where we're at right now. I'm just going to say a blanket statement as it pertains to buying a house. If we are good enough to take your tax dollars with an I-10 card, even if you're here illegally, but we are acknowledging you being here because we are taking your tax dollars. If we are willing to take in tax dollars of an individual that goes towards the community good, which is what tax dollars are supposed to go to. But if you are participating within the system, then the system should participate with you. That's my thoughts. And when you think about non-resident, but if we are saying to somebody, we recognize you being here by taking your tax dollars, it makes sense. And it still represents such a paltry amount of what our national population is, that even if you do have non-permanent residents, non-green card, non-H-1B visa holders, if you take the percentage of those folks who are basically taking entry-level jobs over here, they're not running across the Tecate or Tijuana border and coming over here and taking your job over at Hewlett-Packard or Oracle. They're coming over here, and many migrant workers are coming over here and doing the jobs that we won't do. When was the last time you went out in the field and picked strawberries, harvested nuts, framed a house? Hard work for minimal pay. The truth of the matter is, for a lot of folks who are over here legally, and again, I don't want to get into politics on this, but a lot of folks who are over here right now, they do work that people in this country just don't want to do. I'll tell you what, if my generation and me, who was a natural-born U.S. citizen, if I had to go out and work in the fields, your bacon, lettuce, and tomato sandwich would cost you about $95. And the state of California, without illegal immigrants, frankly, again, I don't care. It's not partisan politics. Without illegal immigration, to some extent, would crash and burn. Agriculture is still our number one export in California. We grow 80% of the world's almonds. So, listen, the point is this. I don't think that this is that big of an issue. And if you find yourself in a conversation about, do whatever the hell you want to do. I just think that this one's kind of ridiculous, but I know it's a talking point, so I wanted to bring it up. Let's look at this one. Fannie Mae is set to drop its 620 credit score minimum. Mortgage giants will instead use its own analysis of risk factors. Officials say they're easing barriers on borrowing. Boy, we all know how well that works out. It's just the latest in a series of policy changes aimed at creating home ownership opportunities in the United States. This is ridiculous, and again, as I told you guys yesterday, nobody is going to write these loans. All right, affordability is driven when renters buy their first home. So, we have housing affordability goes down, as does the median age of the first-time home buyer. Affordability drops down here. The median age of the first home buyer drops here. This, all right, see how we go down together? See how we come up together? Bloop, bloop. See how we go up together? See how we drop together? Obviously, the affordability is much more pronounced than anything else. So the average is right around here. This is about where we should be, right? Somewhere in here. So if we're somewhere in here, here's the median age of the first-time home buyer. So somewhere around 32, 33 years old. That seems to be about the average. That, by the way, is adding this in, which is where we're at right now. See this blue line over here? This is a problem. See this red line? This is a problem. We want this to be right around here for both of them. Affordability has to come down to where the median is, and the average age should be right around 33. Let's put it right there. That's about the median. These numbers both need to come down. Housing affordability. Okay, so if we are sitting right now with our average age of the first-time home buyer, 40 years old, horrifying, and the affordability for first-time home buyers, this number needs to drop right down here. So we need to lose, to get the red bar down to where we have here on our median, where we get a healthy market, we would need to lose about 10, 20, 30, 40, 35% of the value on our houses. So that house that you bought today for $500,000, you'd need to lose about $175,000 off of it. Your house right now, if you have a $500,000 house, if you want that to be a reasonable appreciating commodity that you purchased, would need to be about $175,000 cheaper than what it currently is. Is that going to happen? Ooh, if it does, it's going to be painful. And of course, we don't want that to happen. Home price to debt to income ratios over the past 50 years. The dotted black line is the average. Over the last 50 years, our debt to income ratios. And you can see that'll put you at about a 42. 41. 41% is your average debt to income ratio when it comes to your housing expense plus all your revolving and installment bills. Everything on your credit report plus your house payment. Now, what's changed since then? Insurance, through the roof. Taxes, actually through the roof. Now, this one right here, this graph that you're looking at right here, this is the one that is absolutely shocking to me. So if our average debt to income ratios are sitting at 41 over the past 50 years, which is this black dotted line, look over here on our left. This is 1980. Now, in 1980, we barely went above the average, and look what happened immediately afterwards. We saw property values on a national scale, they went down. It was proportional to the amount we went above the median in terms of our debt to income ratios. But after this was the Volcker years. After this in our 1980s, we saw all of these years without any type of significant inflation. Now look what happened. Property values started sinking down right around here in the mid-1990s. We started saying as a general national policy, the real estate industry is collapsing. Property values are shrinking. We are losing equity. The sky is falling. So we decided to come out with these loans called subprime loans. Nevertheless, we created products where we could get these massive tropes of non-qualified subprime loans, and we could start writing them for people who didn't and couldn't and frankly probably shouldn't have bought a house. And what happened to our debt-to-income ratios? Well, our debt-to-income ratios went through the roof because those full doc deals got sabotaged by all those stated income deals. Property values skyrocketed because we had so many more people in the pool of potential buyers. And then once property values went way up here, built on the back of all those crappy loans that were invariably going to fail, what happened? And they came way in the hell down, didn't they? This was where we saw that 40% drop in values, and everybody lost their freaking mind. All about debt to income ratios. Right here in 2010, we hit our national average. In 2002, we were at our national average. Most of the time, our debt-to-income ratios, we've been fairly conservative, right? Because we're below the dotted line. Now, what's happened here? The buildup. And right here, at about 2017, we went above our national average when it comes to our debt-to-income ratios on originated mortgages. By the time we got to 2019, we were way above it. And then, oops, remember, we're above it again. 1, 2, 3, 4 times. In 50 years, that's it. And every time, adjustment, value adjustment, massive up, massive value adjustment. We went above the line here a little bit, little value adjustment. That's when people said, screw it, we're not buying houses. It's too expensive. But now we have values and affordability worse than it's ever been. So if the previous 1, 2, 3 times in the past 50 years, we had a pullback from buyers because they didn't want to deal with not being able to make the payment on their house or something that's unaffordable, well then, we're going to have a correction. Now, you could be saying to yourself, well, Brian, we've already had the correction. Here's what I have to ask you. Is this over here, is that a reasonable correction for our debt-to-income ratios being here? Our debt-to-income ratios went up to this. They dropped to this. This and this kind of look similar, don't they? No, guys, but this is here. This is inflation. We had bad inflation back here. Our no inflation went from this period to this period. Now, we're here. Right here is we have bad inflation. We had bad inflation back here. Volcker did something about it. We had this great span of low inflation. But now we've got bad inflation again, and we haven't dealt with it. So we have big spike in debt-to-income ratios, small drop. Small spike in DTI, small drop. Big spike in DTI, big drop. This is inflation, my friends. This right here is inflation. We have yet to account for this. So if everything holds true, and I don't see why it wouldn't, I fully expect to see this to do what they've done every other line. About that, having our blue line go down to here, that makes the most sense. Somewhere down here. If this line goes to here, if this line goes to here, if this line goes to here, this line, inflation, should go right around there. What am I saying, guys? That means $175,000 in a price reduction on every property that was just purchased over the past 12 months, 24 months, 72 months. Seems very, very likely. What are your thoughts about it? Am I completely off base with this? I don't think I am. And that should be scary to everybody. I'm telling you right now, guys, we have a massive, massive correction, and it is right over the horizon. What you do with your time, your energy, and your resources as a salesperson, that's what you are as a loan officer and a realtor. You're a salesperson. But we're going to see a ton more attrition in this industry, and the numbers that we just looked at, they're foretelling a story where we already know how it ends. Let me know what you think in the comments down below. And again, if you want to be a part of our team, sorry if this was kind of a boring one, but I think that the charts are very, very important, and I think they deserved a little bit of reverence and a little bit of just methodically looking at them. So I hope this was helpful for you. Keep your conversation going, like, share, and leave me comments.